As we approach the halfway mark for 2023, let's take a critical look at the strength, weaknesses, opportunities, and threats to this current marketplace and help you stay on track for financial independence. The two most standout strengths were in large cap stocks and in short-term bonds. Large cap stocks like the S&P 500 increased approximately 9.5% by the end of May 2023. Taking a step back further, we can see the market hit its lowest point in October of 2022. And since then, it's increased about 20%, which technically qualifies as a new bull market. The question is, will it hold? Well, for now, investors seem optimistic. Tech stocks especially saw a boost from investors hoping to benefit from AI in its new frontier. Though PE ratios, price to earning ratios, are feeling very stretched, and we'll cover that more in a moment. The second big strength is for fixed income investors, particularly those in money markets, CDs, and short-term bonds. And they breathed a sigh of relief as interest rates approached 5% by the end of May, resulting in a significantly more yield than they've experienced over the past 10 years. Now, ironically, turning towards weaknesses in the market, persistently high interest rates, while it is nice for fixed income investors, have proven to be extremely frustrating for banks, real estate investors, and small cap companies. If the Fed keeps rates high, as they've said they will, this will continue to grind banks, real estate, and small-sized companies to a slower and slower halt, the result of which could have serious impacts on our economic growth and could cause potential recession that we haven't yet officially experienced. Nonetheless, there are opportunities for investors to tilt towards value-oriented stocks and a continued dollar cost average into the market, and also learn from last year's market turmoil. Now, this first opportunity is to have a disciplined approach to buying companies that are profitable and whose stock prices isn't overly expensive. Now, we can gauge this by looking at the price to earnings ratios. Tech stocks as a group are approaching a 25 PE multiple, significantly higher than their 20-year average. And at the same time, dividend and small cap companies have PE ratios more in line with their 20-year average, suggesting these companies still offer investors a high expected return profile over the long run. The second opportunity is for those who are still working, is to consistently add to their portfolio with automatic contributions to their 401k and their brokerage account. And the best way to compound is simply to have a greater number of shares. To use an analogy, imagine a farmer who wants to increase crop production. Should you squeeze more seeds on the same field or buy more fields, allowing you to plant more seeds? Well, the answer is obvious for farming, but it can be confusing for investors. The farmer experiences more efficient growth because as the crop produces seeds on the old land, the farmer gets to plant new seeds on the new land. And this results in a compound harvest next year. This is the path for those seeking financial independence. Now, the final opportunity is again to learn from last year, specifically the areas that endured the worst volatility. Investments like Netflix, Facebook, and Bitcoin fell over 70%. Now imagine having $100,000 in one of those investments and waking up a year later to having your investment be worth only $30,000. It would feel demoralizing. These investments lured people in with their explosive growth, but when the music stopped, it resulted in a brutal crash. Going forward, we should gut check our impulse to run after high-priced and expensive investments and stay broadly diversified to avoid the unnecessary volatility and heartache. This leads us to the threats in the marketplace. The first threat is to be mindful of the fact that while the increase in stock prices is a relief, we should be sober-minded about slow economic growth ahead. The Fed is still raising rates, and if they keep them too high for much longer than the market anticipates, this could throw us into a recession. The second threat is to be mindful that we can sometimes be our own worst enemy when it comes to reacting to volatility in the market whenever it strikes again. To share a real-life story, I know of a case where an investor decided to sell their entire portfolio in October of last year. Granted, the outlook was nerve-wracking, and we were in the depths of the lowest points of the market without a clear path forward. And while anything could have happened at that time, now that we get to look back, this investor has missed out in over a 20% rebound. When we look at history, while the cause can be unique, the trend is fairly common. These cycles of up and down occur, and we should expect volatility and remain disciplined to a diversified portfolio. Now, to summarize, let's take a step back and imagine for a moment you're an investor who has either 5 to 10 years to retirement. The strength for investors who held on to their investments is that you largely have been rewarded with a nice increase this year. And there's still an opportunity for reasonable returns in a diversified portfolio. And the best way to get to financial independence is simply set up automatic contributions to a brokerage account and 401k. Now, we do need to be mindful of taking a concentrated investment in any one asset, and we should also have a realistic approach to volatility ahead. On a personal note, I have to share, having worked with countless families over the past 12 years, I've seen hundreds of financial plans. The ones that are most successful are the ones who have a habit of making ongoing contributions. They remain broadly diversified and avoid the temptation of high-priced investments, and they remain calm under volatility. Are you concerned with your retirement plan? I'd love to connect. You can reach out to me directly at john.chapman@wpwm.com or look for me on LinkedIn or Twitter. And with that, happy investing.